Chapter 2 covers business valuation and long-run business value. The comic on the right says 12 financial analysts came up with 12 different valuations for our company. All they had in common was the $500 per hour fee. Now, this is true. Valuation is part art, part science. Here you see the valuation model that we'll be using for valuation of the equity in the company. First, we gather historical financial data. Second is we'll analyze the historical data, and that in combination with our expectations for the future will lead us to some projections. Third, we will estimate the free cash flows and the terminal value of the company. Fourth, we'll discount those free cash flows and terminal value to get to an enterprise value. Fifth, we will then establish the total value of the enterprise with some adjustments. And then finally, we'll subtract out the debt to get to equity value. Step 1, gather historical data. What data do we gather? Some of these are very straightforward. Revenue, cost of goods sold, operating expenses, which lead to earnings before interest and taxes. Next, we can derive the estimated tax rate based on the effective tax rate paid by the company. That leads to a stopping point of NOPAT, net operating profit after tax. The author uses OPAT, but I believe the more common term is NOPAT, net operating profit after tax. To that, we adjust to get to free cash flows. Those adjustments are add back depreciation, which is a non-cash item. We subtract the estimated capital expenditures for those future years. The last one is the one that causes students most confusion, and that is the estimation of operating capital. So here we see the definition of operating capital. It equals the operating current assets minus the operating current liabilities. And you may say, that sounds like working capital. The difference between operating capital and working capital is that working capital includes cash and securities, which are excluded from operating. And it also includes anything that might relate to debt, repayment of debt, principal, or the interest. So when we look at operating capital, we exclude those items. The adjustment for free cash flow is not the number in its entirety, it's the change. So as the operating capital needs increase, then we have to save some cash to pay for that increase. That's why it's the increment. You'll see it denoted here as increase or decrease, with increases being subtractions since we're spending money. Step 2 is use your historical analysis and your judgment of the future to impact what we think the future will hold. Then we'll quantify those and project out the investment horizon, getting to the bottom line of free cash flow. Step 3 is at the end of the planning horizon, we have to estimate the terminal value because the company will continue. We're just going to sell it. So the question is, how do we estimate the terminal value? There are different methods we could use to estimate it. Some are based on multiples, such as price earnings or sales multiples. Others are based on perpetuity formulas, such as the no growth or perpetual growth. In the end, you could try all of them, look at them, and use your brain and judgment to come up with the terminal value. There's no one perfect answer, as you might imagine, and your judgment might ultimately give the best answer. Step 4 is to discount what we just did, the free cash flows and the terminal values, based on the weighted average cost of capital. That will then derive a number today, as opposed to spread out over the entire planning horizon. Following that, we can get to the total value of the enterprise. We take the sum of the present value of the free cash flows and the present value of the terminal value, and to that we add excess cash and non-operating assets. Excess cash and securities we talked about before. These are items that are a war chest, if you will, unnecessary to continue the company. So we hold those out and add it at the end, like now. And there may be some non-operating assets. In general, companies don't have a lot of that lying around because they're evaluated on their ability to keep their asset base nice and tight. An example of one exception to this is there was a stock of a company near my home, about 2 miles from here, and it was a racetrack. And whenever you looked at the financial returns of the company, you'd say, it doesn't make sense that this company is so valued because of this racetrack. Then you realize that that racetrack owned a large racetrack for the public, practice tracks, stables, and a lot of excess land. And that land was right in the heart of the city. Ah, I get it. The value of that stock wasn't the operating value of the racetrack. It was that in combination with this extraordinarily valuable land. A few years ago, they sold all the land and made a lot of money. So it did liquefy at some point when they sold their non-operating assets. Step 6 is estimate the equity value. So we take the enterprise value, and from that we subtract the debt and get to the equity value for the company. If we know the common shares outstanding, we can divide the equity value by the shares to get price per share. As we did in other projections we did during this course, we can extend the analysis by doing some sensitivity analysis. On the left, we see the sensitivity of the value to differences in the weighted average cost of capital. And as you might imagine, it has enormous effect on the value of the company. On the right, we see a sensitivity analysis across two dimensions. First is the sales growth rate, and the next is operating income. In the center, we see the shaded area. That represents the base case. So we can vary along one dimension, either operating income or sales growth, or we could do a combination to see how they interplay. Both of these analyses are examples of what we've done in prior parts of this course, testing the sensitivity of our projection model. The second type of extension analysis is scenarios. Here we have our base case on the left, and we estimate what would happen if there's a prolonged recession. That's going to reduce the value of the company. Next is what would happen if we fail to deliver new products on time. That also would reduce the value of the company. And on the high side, what happens if we have some tax reform and the rates go down? Therefore, all our free cash flows would rise. Obviously increase the value of the company. And our final topic is beyond the financial numbers, what drives the value in the long run anyway? These are partly based on financial results, but other factors such as the management ability and other aspects of the market perception are also important. On the financial side, we have revenue growth, we have relative pricing strength, which looks at the margins we're able to attain from our product based on our competitive position or the differentiation of our company in the eyes of our customers. Third is operating effectiveness, followed by capital management and cost of capital. And on the far right, we see the intangibles. These could be brand value, reputation, or the future expectations for the company in general. The bottom portion represent what drives and ultimately becomes measurable in these financial measures. The items that are action-oriented would be, first, let's run our business. We have organic growth in sales of the company, but we can augment that growth through an acquisition. So M&A activity also has some bearing on the revenue and the profile of the company. There are other specific actions and characteristics of a well-run company that all have value, which ultimately ripples through into one or more of the measurables. Things like our ability to think through revenue generation, also sales management or supply chain management, our ability to manufacture high quality efficiently with excellence in the factories, our process efficiencies internally, such as our IT infrastructure or our ability to manage the retention of key employees. Also, new product development, keeping our company fresh with new products and new lines of business. Then the characteristics of innovation, agility, and foresight. Our ability to look into the future and see signals of change that will give us a clue as to where the company is doing so we can anticipate and start moving into the direction of our market. In the right side, we see some fundamental components to a company. Our ability to innovate, the human capital we've accumulated, our management ability, our ability to anticipate risk and mitigate or eliminate risk. Then it's a predictability and consistency of our performance. That could be on generating revenue, earnings per share, stock growth. All of these are rewarded in the eyes of the investment community. And finally, capital structure. All these come together with our blending of debt and equity and ability to convince outside sources of capital to support our company and our future growth. This is an estimation of the value that could be created by specific actions. We saw the business drivers on the prior slide, but here are examples on the impact of certain actions into the metrics leading to value of the company. We look at sales growth, growing faster than anticipated, or improving our profitability with gross margin or operating expenses. Tax rates, if we were lucky with an external event with a lower tax rate, that would increase our cash flow and our free cash flow and therefore our business value. And weighted average cost of capital. If we're able to attract lower cost capital from debt or equity or both, that would increase the value of the company. So chapter 22 covered business valuation with a model using free cash flow, and we look at some of the business drivers that lead to long-run success.